Welcome to The Explainer. So today we're going to talk about something you think you know all about. But what if I told you that most of what we've been taught about money is just wrong? See, most of the money in our economy isn't printed by the government, and the real story of how it's created is one of the most misunderstood ideas in all of economics.
All right, let's just dive right in with a question that kind of blows up the whole myth from the start. Think about it. If banks are just middlemen taking money from saver A and lending it to borrower B, then the total amount of money in the system should never really change, right? It just moves around. So where does all the new money for economic growth actually come from?
Well, to get to the bottom of that, we kind of have to go back to school. And actually, we need to unlearn one of the biggest things most of us were taught in Econ 101. It's a model that has shaped how people think for decades, but as you're about to see, it's fundamentally wrong.
You've probably heard of this thing called the money multiplier. The story goes something like this. You deposit $100 in the bank has to keep, say, $10 in reserve, and then it lends out the other $90. That $90 gets deposited in another bank, which keeps $9 and lends out $81, and on it goes. In this story, banks are just passive players, just moving savers' money around.
Yeah, but that's just not how it works, and don't just take my word for it. Central banks, including the Bank of England, which we're quoting right here, have been very clear for years, the textbook model is flat out wrong. In the real world, it's the complete opposite. Banks don't wait around for your deposits to make loans. They make the loans first, and the very act of making that loan creates a brand new deposit, brand new money out of thin air.
So just look at how different these two models are. The myth on the left is this neat little circle. Savers give money to banks, and banks give it to borrowers. But the reality on the right is so much more direct. When a bank approves your mortgage, they don't go check some vault for the cash. Nope, they just credit your account. They type numbers into a computer, and poof, new money exists that didn't exist a second ago. Loans create deposits, not the other way around.
Okay, so why does any of this matter? Well, it's absolutely crucial if we want to understand one of the biggest economic puzzles of the last 30 years, Japan. Getting this concept of money creation right is the key that unlocks why Japan's story played out so differently than everyone expected.
So the story we've all heard, right? Japan's economy stalls out, so the central bank goes on this absolutely epic money printing spree. They called it quantitative easing, and Japan was the poster child for it. You could see the Bank of Japan's balance sheet just go vertical as they bought up tons of government debt to try and get things moving again.
But here's the mystery. If they were cranking up the money printer 24/7, where was the inflation? Why didn't prices go to the moon? Instead, Japan got, well, nothing. Decades of economic stagnation and even falling prices. What gives? This gets to the second huge misunderstanding about money.
The answer, and this is probably the single most important idea in this whole explainer, is that there are two totally different kinds of money. On the left, you have base money. Think of that as wholesale money, the plumbing of the financial system. It's created by the central bank, and it mostly just sloshes around between commercial banks. It almost never touches you or me. On the right is broad money. Now that's the retail money. That's the money in your checking account, the cash your company uses to pay you. And how is that created? You got it, when commercial banks make new loans. Japan's printing was almost all base money.
And this chart just lays it all out perfectly. Look at Japan, all the way on the right. Despite all those scary headlines about money printing, the amount of real economy money, the broad money, it barely grew. It grew way slower than in the US or Europe. All that base money the Bank of Japan created, it was basically stuck. It got trapped inside the banking system like water in a clogged pipe. It never really flowed out into the wider economy. And here's why. Well, the government was trying to pump money in. The entire private sector, companies, regular people, was doing the exact opposite. See, just like making a loan creates money, paying back a loan destroys it. And for decades, Japanese households and businesses were obsessed with paying down the giant debts from their 1980s bubble. It was like this massive tug of war. The government was pulling on one end of the rope, trying to create money, but the private sector was on the other end, pulling even harder, destroying money. And in the end, the private sector won. Okay, so that's Japan. And this is where it gets really interesting for us today. Because for years, you've heard people warning that the US is turning into the next Japan. But once you apply this framework and look under the hood, you realize they're not just a little different. They are, in many ways, polar opposites.
First off, let's just look at their position in the world. Japan is the world's #1 creditor nation. That means the rest of the world owes Japan more money than Japan owes the rest of the world. And the US? The complete opposite. We're the world's biggest debtor nation, by a mile.
Second, let's talk trade. For decades, Japan has consistently sold more stuff to the world than it buys from the world, running what's called a current account surplus. The United States, on the other hand, has done the exact opposite, running a structural trade deficit for as long as most of us can remember.
And finally, just look at where the government's money goes. As you can see, the U.S. commits a whopping 18% of its entire GDP to healthcare, while Japan is at 12%. And we spend over 3 times as much on defense as a share of the economy. These aren't temporary little programs. They are massive, permanent features of the U.S. budget that create a totally different economic engine than what you see in Japan.
All right, so let's pull all these threads together. We've busted the money multiplier myth, we've decoded what really happened in Japan's lost decades, and we've seen why the U.S. is on such a different track. So what's the big takeaway from all this?
Okay, here are the 3 big ideas to really let sink in. Number 1, and this is the most important, new money is born every single time a commercial bank issues a loan. Number 2, Japan's story was never about a government failing to print money. It was about a private sector so focused on destroying debt that it canceled out everything the government tried to do. And number 3, the U.S. is just not Japan. Being a massive global debtor with huge built-in spending commitments means you're playing a completely different economic game.
And that leaves us with this one big provocative thought. The world is watching a massive economic experiment play out in real time. What happens when you apply policies designed for a creditor nation with slow, broad money growth to a debtor nation with completely different dynamics? Nobody really knows for sure, which means the next chapter in this story is anything but certain.